Okay, so this is where the opportunity is. So the big thing is you want to focus on your tax structure so there's some rules of thumb. So an operating company, meaning a business, it's generally be best in an S corp. And in this case, it's your real estate brokerage. That belongs in an S corp or an LLC tax as an S corp. Now your rental real estate investments, those belong in an LLC, and it'll either be a single member LLC or an LLC taxed as a partnership. And I'll show you why that you don't want that in the S corp. So put your business in an S corp and your investments in LLCs.
Well,
Now,
hold on,
if there's high tax
Kevin,
investments,
let's just stop there for a
yep,
minute. I'm
you bet.
curious. Everyone, look, we got scores of folks on this call. Everyone, let us know right now what entity your brokerage income is structured in. If it is a sole proprietor, is it C Corp, is it an S Corp, LLC? Everyone let us know what it is, okay? And it is what it
Yep,
is. We can't
yep, lots of S corps here. Great.
sole proprietor, I got a couple of sole proprietors here,
Yep, I see a few of those. Yep, and we'll talk about
and they're
that.
getting their asses kicked on taxes.
Yeah, yeah, and if there's not an LLC wrapped around it, there are also asset protection
Yes.
issues too. Yep. Okay, great. All right, I'll show you in a minute exactly why. I'll show you the math of why the S corp makes sense, and also rental real estate. Now, if you got high tax investments, doing a self-directed IRA can make a ton of sense. So fixed income investments. I also run a hard money fund. Love that asset class, private credit. That is perfect for a self-directed Roth IRA, right? Because instead of paying that 40.8%, if we go to the previous slide, that's where hard money would get taxed. We move it down to that bottom row, Roth IRA taxed at 0%. So that self-directed IRAs make sense for high tax investments. And then if you had excess taxable income, if you're in the two comma club, 7 digits of taxable income, then adding a C Corp to do what's called tax arbitrage, right? You're getting a deduction at the 37% and bringing it down to 21. That's how that works, right? And notice that this structure stuff, we haven't gone out and bought anything, right? Our dollars are kept in-house. We're just choosing how we're going to be taxed. All right, so thanks for answering. Looks like most of you
Kevin,
are.
Kevin, let me stop you in a second. Some of
Yep,
you, I know some of you on this call are in the seven-figure club. Awesome. That means seven figures net, not gross,
yep,
obviously.
net.
But this idea of, and we do it, the idea of the management company to, again, everyone understand this is structuring yourself and your estate in the ways you can take different entities and take different tax buckets and realize what you're paying. That's what we're talking about here. So how you structure it is really important. And when you're making more than seven figures, the second company, the management company, is a great way to defer a lot of taxes. Okay.
Yep, sure is. And our goal with our folks in the two comma club, which is almost everyone, we use a general theory of less than 30 that we know that if we structure it, we should keep their effective tax rate below 30%, right? So we keep them out of the top two rows and down in these bottom rows. And that's how we do that, no matter how much they're making. So that's the goal. Okay, as I mentioned, your brokerage business probably belongs in the S Corp and rental real estate in the LLC. So why does your brokerage belong in the S Corp? Number one, it's a single layer of tax. And this is an Inc. or an LLC tax as an S Corp, right? LLCs can file a Form 2553 and be taxed as an S. And so first thing you're doing is you're saving Social Security tax, which is, you remember, you're the employer and the employee when you're a sole proprietor or own your business. So you save 15.3%. On that, you save Medicare of 2.9%. If you're making over 100 grand single or 200 married, you save Obamacare tax of 3.8. And this business, as long as you file it correctly and make the election, you also are eligible for the Section 199A deduction, which lops another 20% off. So look at all these taxes we save just by setting our business up correctly in the most tax efficient manner.
Okay, Kevin, I gotta stop you there because people are thinking right now. I know what they're thinking. I make more than $100,000. That's what you all are thinking, right? What do you mean by 199A? What is that, an election to my S corp? What exactly is that?
Yep. So the couple things. So your CPA needs to do a few things. Number one, select the correct business activity code. So that's a 6 digit number on the front of the tax return. Very important for a few things. Number one, the IRS uses it to see if you're eligible for certain things like 199A. Additionally, this is how they assemble the data for what's called the DIF score, DIF. And it's how they select returns for IRS audits. So if you, for example, put in the wrong business activity code and submit your return, and the numbers don't make sense for that industry if they're out of whack. So, for example, let's say you got real estate brokerage, but you selected a manufacturing business activity code by mistake, and they're looking for inventory and cost of goods sold, and it's not on your return. That's going to get snagged for an audit, just like that, and vice versa. So it's a very important number. And in this case, it's step one of getting the 199A deduction. Step two is making the election later on the tax return, and step three is reporting the 199A info correctly on both that return and your K1, and then of course your personal return. So if you got a good CPA that works with businesses, this should make sense. Where I see folks miss it is either they're doing their own stuff or they're working with a CPA that mostly just does 1040s and not businesses that just do personal, or they don't work in their industry, and that's where this stuff can get missed, and it's a bummer.